What's going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today we're answering a question I got twice in the last month. What happens if the seller's loan only has 25 years left on it? You're taking over a used loan, right? Did you just lose 5 years? This one's for buyers, but sellers, stick around. The last part of this episode is for you. Here we go. So, quick background on how this works. When you assume a mortgage, you step into the seller's shoes. Their rate becomes your rate, their balance becomes your balance, and their clock becomes your clock. So if the seller bought in 2021 with a 30-year loan and you assume it in year 5, you get the 25 years that are left. You do not get a fresh 30-year clock. And when people hear that, some of them get nervous. Like, wait a minute, am I paying full price for a partly used loan? Now, before we freak out, let me give you a real example. Say the seller bought in 2021, $400,000 loan, 2.75%, 30-year fixed. Their principal and interest payment is about $1,633 a month. 5 years later, they sell to you. The balance is down to about $354,000. You assume it. Your payment? Still $1,633. The payment does not change, right? Same rate, same payment, just fewer years left on the clock. Now, I know what you're thinking. Okay, Ryan, but the seller got 30 years and I'm only getting 25. Feels like I'm getting the short end here. Here's what most people don't realize. You're not getting a worse deal. You're getting a better one. And this is the part that blows people's minds. Every mortgage is front-loaded with interest. In the early years of a loan, most of your payment goes to interest. Barely anything touches the actual balance. The real principal paydown comes later. So when you assume a loan that's 5 years old, the seller already ate the most expensive, interest-heavy years for you. Let me show you what that looks like. On that assumed loan, out of your $1,633 payment, about $820 goes straight to principal every single month, over half the payment, building your equity. Now compare a brand new loan, same $354,000, but at 6.5% over 30 years. That payment jumps to about $2,240 a month, and out of that bigger payment, only about $320 touches principal. The rest goes to the bank as interest. Think about that for a second. The assumed loan costs you about $600 less every month, and it pays down more than double the principal. You're not losing 5 years, you're skipping the 5 worst years, and that's $600 a month. That's over $7,000 a year. That's a really nice family vacation every single year. That's maxing out a Roth IRA. This is where it gets real. Run it over the life of the loan. On the assumed loan, with 25 years left, you'll pay about $136,000 in interest before that house is paid off. On the brand new loan at 6.5%, about $450,000 in interest. That's a difference of over $300,000 on the same loan amount, and you're done making payments 5 years sooner. Little hack for you. Flip this whole thing around when you're shopping. A loan with less time left is worth more to you, not less. What if you find one with only 20 years left? You're 35 years old. You assume that loan, and you're mortgage free at 55. Every payment shoveling money into your own equity instead of the bank's pocket. Let me tell you about Dillip, investor client of mine. He put $50,000 down on a $550,000 property with a 2.8% rate. That loan already had a few years of payments behind it, so his tenants are paying down principal at a pace a brand new loan can't touch. That's the quiet part of these deals nobody talks about. The rate gets all the headlines. The paydown builds the wealth. And when we write the offer on one of these, I verify the exact remaining term and the exact balance with the loan servicer to protect you. No guessing. You'll know exactly what clock you're stepping into before you sign anything. I want to make this super clear. Nobody is shorting you 5 years. The seller paid for the expensive years. You get the cheap ones. One more question I get on this. Can I stretch the loan back out to 30 years to lower the payment? No. The loan is what it is, but remember, that payment was set back when rates were in the 2s. It's already lower than anything you could create today. Stretching it back out would just hand the bank more interest anyway. So that is the advantage to buyers. Sellers, if you are listening to this, here's what this means for you. That loan you've been paying on since 2020 or 2021, it's deep into its schedule with a killer rate. So ask yourself, whose home is going to sell quicker? Yours, where the buyer steps into 25 years at 2.75%, or the identical house down the street, where the buyer needs a brand new 30-year loan at 6.5. All things equal, right? Your loan having years behind it is not something to apologize for. It's one of the best marketing tools your house has. Advertise it. All right, let's go get some sweet properties. I'm Ryan Thompson. This is the Assumable Guy Show. If you want to know how many years are left on the loans on my list, and I've got over 1,200 properties on it, hit up assumableguy.com or DM me on Instagram at theassumable.guy. I'll run the numbers for you. No pressure, just math. Next episode, I'm talking to the military retirees. Should you let a buyer assume your VA loan? You might be sitting on the most wanted loan in your neighborhood, and I'll show you how letting it go can put more money in your pocket, not less. See you on the next one.